I train directly under industry leaders in insurance, and here's why the richest clients always avoid banks with their savings and what they do instead. Banks, just like human beings or any business, have a portfolio of assets and liabilities. This is how they earn their money. Now, generally, this is going to be mostly made up of loans. On top of that, they're going to be doing much safer things such as government bonds, bills, and notes. They're going directly to the US government and buying these, almost always holding those until maturity. Real estate, and then often for their serious liquid cash, using bank-owned life insurance. Now, how do they get this money for their portfolio to start putting into their investments? This is what the rich understand. People aren't necessarily coming into the banking industry with $1 billion worth of money. What they're doing is they're using, you guessed it, your money. When people put money into the banks, this is the money they are using to go and invest and earn a rate of return. From that rate of return, they are then able to credit you, the account holder, interest. Most traditional accounts are very low, but even if it was a high yield savings and they're able to credit, say 3 to 5%, depends on the interest rates, the only reason they can do that is because they're earning higher with their portfolio. Well, what do we notice about where they're putting their money? Aside from the loans, well, that's another topic in terms of the morality of those, but the government, real estate, and cash value life insurance, these are all things that are very accessible to any human being. So if the banks are putting their money here just to credit you interest, why not cut out the middleman and do it yourself? And this is exactly what the rich are doing. See, the reason that they're able to credit, let's say 3 to 5% on that high yield savings account, again, is because they are taking your money, all of the people that put their money in the banks, they are investing that money in these things here, and they are earning more than this number here, therefore they can credit you that number. So instead of letting them do that for you, what the rich are doing is they're going directly to these assets that the banks are investing in to credit you money. So things like the government, you can go directly to the government to buy these T-bonds, bills, notes, whatever it is. Real estate, you can do this on your own, of course, whether it's land, houses, buildings, does not matter. That's something you can do on your own. And then you can also do cash value life insurance. It doesn't have to be bank owned. This is another place to keep liquid money. In fact, insurance companies do the same thing where they invest and then credit you interest. The only reason the rich are often willing to do this with insurance companies but not banks is the safety of the institution, not keeping money in the market or having it be much less volatile, and the tax benefits that come along with that. Banks themselves understand this. That's why they're not keeping their money in other banks. The whole industry, because it's a business, is built off of profiting. And when it's just a place for people to park their money, well, what are they doing? They're taking that money and going and earning rates of return that you could do yourself. Hopefully this was helpful. If you enjoyed, subscribe.